Hey, it's Anthony and Tucker with Land Title. We came to bring you your big Boulder County update for the month. This is where we talk about kind of the lender perspective on everything. So let's dive right into what we've been seeing. We have a very big tale of two markets right now. We have the detached market, which is what we're going to look at right here, and it is very much steady Eddie, right? Very stable, very similar to last year. Look at this, 5% decrease in active listings over this time last year. Seasonally, we're rising in inventory like you would expect. The under contract numbers are bolstering, right? Buyers are kind of coming back to market. It's everything you would expect to see from a March market, right? And honestly, 2% increase in average sales price looks pretty good. It's very what we would hope for and what we would expect. The flip side of the coin, though, Tucker, what's going on attached?
So attached is doing the exact opposite. And not to be negative here, but just saying what it is and what the numbers look like. Attached started off the year pretty decent. January, February were looking good, and then geopolitical things got in the way and are still getting in the way. And that's where you can really see how sensitive this attached market is. Active inventory is up, but we went down in pendings from February into March. That is so incredibly rare. Of course, interest rates don't help, but I just can't stress enough how unusual this is for our under contracts to be declining in the spring market month over month. So just really keep your eye out there. There's a lot of value in the attached market for your value buyers. But really, as a lender out there, just know there's going to be some screaming deals here in the next couple months for your clients as a lender if they can stomach those HOAs.
All right, so let's look at active listings across the county. Now, Tucker and I always give you this slide so we can break it down by city. There's been some really unique changes, right? Number one, the city of Boulder is very flat, right? I think it's worth noting. Higher price point, very similar to last year. Erie, Lafayette, and all the way down into Superior, also like a pretty big decline in inventory levels, right? So they're going to feel very different than they did a year ago. It's going to be a little bit tougher to get your buyers under contract in those places. They may have less cards than they were holding a year ago. Not that it won't get there, but this is an interesting start. And then, of course, we have the other markets that have more inventory, right? Longmont actually has more inventory than it did a year ago. Niwot, being more of a luxury market, has a little bit more inventory. So it's very interesting dynamic. We're all headed the same direction, but those are pretty drastic changes compared to last year.
Now let's flip this. We're seeing year-over-year increases across the board except for Superior, and that's really because a lot of them were new builds that were on the market in that downtown area. Outside of Superior, month over month, we're seeing pretty large, single, mostly double-digit, 15, 14% on the lower side, even up to 19% like in Lafayette. Erie had a huge jump in attached. So if you have clients shopping for those attached units, where the inventory is, well, it's stacking up everywhere. So there's going to be a lot of options, a lot of things that they can make decisions on. And really kind of in this attached market, based on this inventory, your clients don't have to move too fast, right? You can get more due diligence done on the front end with attached. So you can help share that with your buyers is, hey, there's some great value. We can get a lot more due diligence done before even writing an offer and, tying up earnest money.
Yeah, the opportunity there is going to be pretty immense here soon.
It might be a while till it bonds.
If you look at month supply of inventory, this is the one where I think it tells most of the picture, right? If you look at a lot of the cities like Louisville, Lafayette, Superior, Erie, they have less than 2 months of inventory, right? It is truly a buyer's market or a seller's market again in some of these. It won't last for long, but it is for right now, where there's just sellers are, able to be a little more picky, and some of those concessions are dropping and everything, right? But you have the flip side where the more expensive part of the market sitting at 4 months of inventory, there's not as many buyers that can afford those. And I truly believe that, here we are kind of starting the year at the lowest point of inventory, moving into a higher inventory market. Just be prepared for this to change, right? And attached, well, this is a fun one.
Yeah, more of the same. I mean, our lowest month supply of inventory is at 3.7, 3.5% pretty much. And that's out in Erie where it's all mostly new construction or very new.
Yeah. Townhouses, not condos, right?
Yep. And so that's where we're seeing different product, a little bit lower month supply of inventory. But when it comes to that true older attached condo, townhouse, piece of the market, it's really not moving. And anecdotally, though, the townhouses that are, live more like a single family, fenced in yard, have a little bit more of those amenities and a little bit more of that space, those are doing a lot better than the rest of the attached market. So just help when you're working with your buyers, the ones that live like a single family with a yard are going to go faster than your true condo, true, row townhouse that we have a lot of inventory of here in Boulder and Longmont.
And if we look at days in MLS, just the speed of this market is really unique because surprisingly, it's actually gotten a lot faster, even in the detached, right? Granted, we have lower days or month supply of inventory, but I mean, a lot of these, look at these, they're in the 30s, right? Some of those are in the county are doing really well. City of Boulder, higher price point, right? Just like Niwot in the mid 50s. I mean, really, it's exactly what we would expect. This market is just chugging along at its same pace it's been for the last few years, but we really are starting to see some changes here. And the attached market's doing something very different.
Very different. Now, we see some of those numbers are seem pretty low. Remember, that's based on once they've closed. There's a lot out there that hasn't closed or is under contract. So we're going to keep seeing this number higher than it is. And really next month it's going to skyrocket just based on how much more has come on the market on the averages. And really just across the board, you can really see it. Louisville at 75 days, Superior at 110. That's also some of the new construction. Even Longmont at 85 days. There's time for your buyers. Now, when is there not time? Certain places like Niwot, but there's 13 places in Powderhorn on the market right now alone.
Right.
So your days in MLS are about to skyrocket going into next month, which is just further showing a lot of opportunity on the buy side, but I don't think we've hit that bottom yet, unfortunately.
It's true. Now, if we look at the actives and sold by price range detached, I think it's worth talking about a few different segments here. Now, if we look at the luxury stuff, you can see that people have started to get a little more realistic on price. We've seen less $3+ million sales. Some of that, actually, a lot of the $3+ million is the ultra luxury, way up there. And that 2.5 to 3, a lot more sales taking place as people have dropped price for a couple of years, maybe even to get there. And then the 2 to 2.5 million, we're also seeing a little bit of an increase there too, 17%. The one part that really has actually struggled this year, which is kind of surprising, is the $1.5 to $2 million market. I think it's just still a cost of money issue, right? It's just expensive to borrow. People are making decisions whether they want to or not. But a lot of them clearly have been buying the 1 to 1.5 range instead because 40% more solds in the 1 to 1.5 market. And then as money got a little bit cheaper there for a little while, 800 to $1 million also boosted a little bit. So we've really seen just, some pretty normalized changes in this market. Just remember, it's the 4th year of this market cycle, right? Mm-hmm. We're moving into another year where detached is just hanging in there, doing its thing, staying strong, which is good news.
And that's Boulder County, right? Boulder County is the gold standard because it's stable. Right. It's stable. Not huge highs, not huge lows. Stable.
Well, then there's attached.
Yeah, which is a whole different story. So we did flip a coin before this to see who is doing detached and attached, and I lost. That's why I'm doing attached. So hopefully you're picking up on the attached is struggling. But when we're looking at this, what we're seeing is very little is being sold in the luxury attached market. A lot of that higher end lock and leave really just isn't moving right now, whether it's new or even recently built in the last 5-10 years. It's just not moving, right? That cost per square foot for your attached and especially that luxury lock and leave attached is just not lining up with detached that well right now for what you can get. So we're just seeing a further erosion in that upper luxury market and attached. Now, where are we seeing the sales? Well, the lowest price bands, right? That $300,000 to $400,000, and that's because
under 300, which is amazing.
And under 300, which there normally is not a lot of. But really, from that 400 to 600 range, a lot of condos in the city of Boulder, and even some of those, townhouses or condos out into the county and more into the L towns. They're a little bit lower in cost, but that's where we're seeing prices are falling so much that we're now getting more action in those lower price bands. And it's not because the inventory started there, it's because the prices are dropping into there. And I think that's something really to keep an eye on is prices are not doing well. And it's really being reflected by our solds, whereas we can see how much inventory we have on the market. I mean, we're talking less than 20% absorption in the best month.
In the
best
right?
price bands, right? So when we're looking at that by month supply of inventory,
this is one more. You want to go to detached?
Yeah, let's just stay on this. And so while we're talking about this, you can see how we're starting at 3+ months supply of inventory.
It's really more like 5 in most of them too, right?
And it's going to be spiking by the end of this month, by the end of April, because we had so much more come on the market. And what this means is that it's really a buyer's market, and even more a buyer's market than it has been even in years past, because prices are still falling. And now that the inventory is building up, people are going to get desperate to make deals. So if you're aggressive buyers, really look at attached. There's an amazing value over the next year, maybe even 8 months there.
Yeah.
while it's bottoming out. So there really is a lot of value there.
Yeah, and they're clearly purchasing. You can see some of these price bands are way lower days in MLS. If the product type is really good, they really are walking in, seeing some buyers active in that market, but they've so much to choose from. They're only putting under contract the very best product at whatever price range that is. And if, on the flip side, when we get to a detached, I mean, you can see the month supply of inventory is under 2 months, under 2 or 1.5 million, right? There is not very much inventory out there, and it is adding up, right? It's adding up quickly, but it takes months for that to happen. The best stuff is just moving rapidly, and you can really see here the luxury stuff. Even though there's 20 months of inventory over 3 million, they're still moving pretty quick when they're good. So the real issue is if it's priced right and it's good, you can absolutely go out and find something. So if you're in that vein and working with that type of buyer, they do have to negotiate and they do have to be kind of, aggressive, maybe more so than they have in the last few years. The other flip side of the coin is there are deals to be had out there, right? And there's a lot of cool stuff out there that maybe just needs a little bit of work, but people, they look at that monthly payment and they go, I am not remodeling a house for that price.
Yeah.
So if you have that opportunity, I think there's a lot to be said about buying product that maybe is not in the best of conditions right now.
Yeah. Especially for those borrowers of yours that have a little extra cash on hand.
Yeah, average sales price is a little bit tough to talk about. I think the one thing you can remember here is we've been bouncing between about 1 and 1.2 million on the average detached single family home for the last 4 years, right? It hasn't changed too much. It's kind of this ebb and flow. Year over year, our change is 2%. It's $25,000, but certain months we've shown a negative by just a hair or two. So a lot of these markets, I mean, if you look across the board, that trailing 12-month percentage changeover tells us a lot. We're really talking 2 months or 2% increase to 2% decrease. It's just really lying in there as very, very stable. So
right. And, if we just did one of those lines of, hey, if we average this, what is it? It's just level. It's just so level flat. Going across it. It's
right.
Flat.
You might have lost a percentage point or two over the last 4 years, but it's so steady, Eddie.
But really looking at it, it's really flat. And that just shows the power of Boulder County and the detached market.
Yeah, we'll keep that cursor and you can talk about this one. This is the attached market.
Yeah, no, we don't want to. I don't want to do that angle because it's not a level line. What we're seeing in the attached market, once again, more continuations of struggles. You'll look at Superior and go month over month, year over year. Why are they doing so great? It's because of the new builds. They have all of that new downtown, higher end attached product. That's what's skewing those numbers. Otherwise, what we're seeing across the county is really what's going on, especially here in Boulder at that 23% month over month change, 18% year over year. But when we look at our TTM, that's our trailing 12 months. We're comparing 12 months to the prior 12 months, so year over year on a rolling basis. All of those numbers are down except for Superior because of the new build product. But you can see how far we are down. But those prices aren't fully reflective, I think. And I think we're still chasing them down because our month over month and our year over year are much more recent information. Mm-hmm. And it's just showing that we are falling as a market. We haven't hit the bottom yet. I was really hoping we would hit the bottom and kind of be bouncing by now in this market.
And honestly, if interest rates had stayed a little lower, we may have already been turning a corner. We're getting pretty close to the point where this is a value buy again, right? To keep in mind, the whole point of an attached product is it's an affordable product, right? And if it's not affordable or it's not super cool niche block and leave downtown Pearl Street, right? Like it just genuinely is this product where you're going to buy a detached single family home instead of an attached single family home if they cost the same, or even if it's close. Mm-hmm. So we're really getting to that point where, every time we look at deals and, from an investor standpoint, they're starting to pencil again. It's really starting to look a little more attractive. And I think you're going to see this flip, but it's hard to say when, right? I mean, I don't want to rub a crystal ball and tell everyone it's going to be perfect and go buy a bunch of attached when it may be another year. Right?
It may be another year, or if interest rates get into those high fives again, thankfully, hopefully,
it might be done.
Hey, maybe we'll start seeing some strengthening and hit that floor and start bouncing off it. I'll let you talk on this one here.
This is sold units. I mean, I think the big takeaway here is the beginning of the year started pretty strong, right? December numbers were pretty ugly, but they're always about the same. Interest rates started so much lower than they were a year ago. We saw more sales. And as that's kind of ramped up, you're really seeing, a much better market in Boulder County, even better than Denver Metro in so many ways, right? Lots of good stuff. This is good news. Now, course, with the war and other things, it has slowed, taken a little bit of a slowdown. It doesn't necessarily mean it's going to stay there. It's just, it might take us a little bit to get back to where we were the last few months. And then in the attached market, a lot of the same stuff, except we started in a really rough spot.
We started really rough, but we had great under contracts in January and February, thus our higher numbers. It'll be really interesting to see what happens here.
That
in
lowering
April.
in under contracts is really going to lead to sales here in the next few months to be diminished. And we will catch up, right? We seem to do this every year lately where for some reason our third and fourth quarters are booming compared to what we would expect. And our summer is a muted month, right? Because buyers are making the decisions, not sellers. There's plenty of sellers out there. It's when are the buyers going to come to market? Well, when they do come to market, we have awesome months. And when they don't, it's just kind of mediocre, right? As we've seen. You want to talk about this?
Sure.
List sale price?
Yeah, for detached. What we're kind of looking at here is, what we saw in the higher end market, that $3+ million. There's a lot of stuff on the market, a lot of competition amongst sellers, so it's great for your buyers. So we saw some sliding there, but really across the board, month over month, we've seen pretty much a strengthening across the board of the small few percents here and there, especially in the meat and potatoes under $1 million or even under $1.5 million, which is a great sign for detached. So we're really just seeing once it gets steady, slow price increase month over month, small amounts of price increase year over year outside of, under $1 million. We're seeing that for the most part. So really what this is kind of telling me is, hey, under 1.5 million, you're going to be offering closer to asking price than you were a year ago.
And you might not get the concessions. I think that's one
and you
huge
may
takeaway.
not, or you'll go out asking and get some concessions, but your hand isn't as strong under $1 million as it was a year ago.
Yeah,
or
it's
even
actually
3 months ago.
Significantly better, which is very cool to see.
Well, it's good for sellers, tougher on the buyers, but
I mean, we're giving
really
buyers
seeing
more than one bone at this point, right?
Yes.
So it's okay.
Really what we're seeing is when we're sitting at 98%, 99%, that's a healthy market because there are still a lot of concessions out there.
Totally.
But people are just going for asking price and getting those concessions. So it's a really good sign in the detached market. Attached, Anthony, it's all you.
Yeah, it's fine. It's actually not that awful, right? I mean, the one thing you can see here is we don't track price drops. Keep that in mind. But once they get to an appropriate price of where the market is pretty stable, it's sitting at 98%. Yeah, there's some concessions there. It's a little worse than it was a year ago, but it's not like the sky's falling here, right? I mean, Tucker and I look at these quite a bit. We've seen markets where things have swung down into the low 90% range, right? And when that happens, you see falling prices. Like think 2009, 2010. It was a very different time in real estate than what we're seeing now. So yes, buyers have a little bit more of an upper hand. I think that's a great thing if you're going to go out there and work with them. There's opportunity here, right? And the detached is so stable that I think we're going to start to see it dig itself out sooner than attached. But I mean, it is what it is. We have two parts of the market, and it's very clear that they're very separate.
And real quick, just on the attached side, what this is telling me is, hey, when I'm seeing 98%, given how the struggles that the attached market's having, and I see our average at 98%, what that's telling me is your buyers are waiting for the price drops to come out. They can be aggressive and go make those offers before the price drop, before the price drop comes. And I know it's tough for agents to write, offers that are low ball and they don't want to be disrespectful.
But honestly, they can come back around to those same houses if they really liked them again.
Exactly. So really, as you as a lender and advocating for them, they can go write some lower offers because until they do their price drop, it's not going to go under contract is what this is telling me.
Absolutely. I agree with you, Tucker. Thanks for joining us today. Hopefully you got something out of our video, and we'll always be here to give you another one next month. So thanks for joining us, and I guess I'll see you soon.
Thanks, everybody. Take care.